Hello again. If you are an angel investor and you have a question like what should be an angel investor strategy for the maximum returns? The another question you may have, how to understand the risks and the rewards with angel investment. Another question you might have, that is it really possible to have 100x or even 1000x returns? And the final question you might have, what is the golden rectangle in angel investment? So if you are an angel investor and have the questions like these, this is the video where you are going to get the answers to all of these questions. Hello everyone, my name is Avkash and you are welcome to another video to help you to be the best and a very successful angel investors. So let's get started. So one day you decided, I have heard a lot about angel investment, and you decided that you are going to be the angel investor. It's great that you have thought to be an angel investor. Once you made up your mind that you are going to be angel investor in startups, very soon you are going to see the various rounds where these startups raise money, and as an angel investor you are going to invest your hard-earned money in one or more these different stages or the startup series. Now you have to be very strategic and smart to choose at which stage you would want to invest in a startup so you could get your maximum returns. And you have to be very strategic in your approach. And before you could establish the strategy for you to be a very successful angel investor, you might have the questions like these. So before we try to strategize ourselves, let's get ourselves familiar with different rounds in angel investment. These rounds are pre-seed, seed, A, B, C, D, E, F, further, and finally, at last, the startup exits. And those exits could be various depending on the startup leadership decisions. As an angel investor, you have to have a very good understanding of these rounds and how these rounds work. I do have a very good presentation about angel investment valuation, or how does angel investment valuation works. So please review that video, and the link is also available here. So if you are interested to learn more about valuation, please review that video. That is going to help a lot. Here, I believe that you do have very good understanding of these different rounds and the valuation for a startup. As you know that any startup, when they are in pre-seed or seed stage, at that time the startup just have very early stage, an idea, a possible solution, and a few folks are working to solve a one specific problem. If you have ability to get the investment at that stage, that's great for you. However, for the angel investors or the institutional investors, most of the time the deals come from seed or maybe pre-seed stage from different syndicate leaders or the different angel investment groups you are working together. So we will categorize the investment in three different segments. One with the seed to series A stage. The next, your investment is scaled from pre-seed, seed, A and the B stage. And finally, in later stages, you have ability to scale your investment from pre-seed all the way to series C or further stages. So we have decided that we are going to use these three different stages of startups where you are going to invest one way or another. If we look into these stages from pre-seed, seed, all the way to EF and the last stages, you are going to see that in early stages, your returns are high multiples. It means the returns in the later stages are lower in multiples. However, the risks are very low, because when you are investing in early stage startup, the product is really very early stage. They may or may not have customers. The product may not have the market validation built into. Growth, expansion, they are all very foreign concept. It means that you are banking on the team as well as the understanding of your problem, its solution, and the market. You believe that if you are investing at very early stage in a startup, it means you are trusting a lots of unknowns, and you believe that this team has capability to win the market and grow significantly. It means your risks are very high. However, comparative to your risks, your returns are very high multiple. And big reason is that because during those stages, the company valuation is significantly lower. As the startup grow from series A to B to C and next rounds, its valuation goes higher and higher and higher. It means the cost of investment is also going to be higher, and then your percentage in that company will be lower and lower. Depending on how much money you are investing and what the company valuations are, you are going to get lower in multiples comparative to early stages investment, and that is very true. However, as you are growing in the rounds like B, C, D, E, F, significantly the company is growing, product is growing, growth is over there. It means the company already has validation built into. It means the risks are fairly lower. So you are compensating your risks with your multiples. Higher risk, you have higher multiples, versus lower risks, you have lower multiples. And it's your choice to fit yourself where you feel more comfortable in these various stages. So let's look into the revenue stage now. So the revenue stage means the company does have a product which is usable by its customer. Your product is solving problem to certain customers, and in return they are giving you some sort of fee to use your product, and that gives the revenue. So you are using your investment in a company which is in revenue stage. It means it has some validation available from the product. It's a good stage, and at that point you do have good understanding that definitely this company is no longer is struggling to get customers. At least it has some customers. So there is some confidence built into. And depending on startup to startup, it could be seed stage, could be A, could be pre-B, could be between these rounds. So that's where the revenue stays. It's a quite safe to do the investment, and you know the risks there, but you do have few factors working in your side. There is a product, there is revenue, there are few customers. Next is needed is the growth and expansion. And if company can establish growth and expand itself in various categories, such as expand its product portfolio, reach more and more customers, expand its team, have its global or significant presence wherever it's needed, all those expansions, they actually drive higher return. A startup can achieve the highest stage by being the market category. One of the prominent company is Google. It established itself as the web search category. Facebook is another one where they became the de facto the social network category. Another company we can call very recently is Coinbase, when they became the crypto exchange. Very recently we have seen Slack, which was the enterprise communication category. Tableau was another one where they are the data intelligence and the visualization category. So once a company hit the market category, they have actually defined themselves. They pretty much became the bulletproof at that time. And that is the place where the exit strategy start coming into the play. Either acquisition could happen, or the company could go IPO, or even in any of these stages. The investors who put money from pre-seed all the way to these growth stages, everybody is going to get their return depending on at which stage they have invested. And the earlier you have invested in this company, the multiple returns will be higher and higher for you comparative to those who have invested in the later rounds. So finally, if we try to create a strategy as being an angel investor, you have to find your own golden rectangle. So what is golden rectangle? So every angel investor can have their own golden rectangle. It means from pre-seed all the way to series A, B, or C, they can choose how they can take their portfolio and invest in various stages. In some startups, they can invest in pre-seed or seed stage where the risks are high but multiples are super high, as well as they can also invest in few growth stages such as series B and C, where the company definitely has very good growth, but the market size is really very big. It means the expansion could be very high in weighting. It means combining some pre-seed investments as well as a few growth stage investments along with a few revenue stage investment, you have achieved your own golden rectangle. And now it's all depend on how this startup play their game and finally gives you your returns which you are expecting from all of these investments. As an angel investor, how you can achieve your golden rectangle. If we try to recap this video, I would suggest you to find your own golden rectangle. Finding your golden rectangle is all depend on how you invest in various startups from pre-seed all the way to series B and C. Depending on how you invest in these various startups and to achieve your own golden rectangle, you have to diversify your angel investment between pre-seed, seed, A, B, and C, or between revenue stage, pre-revenue stage, and the growth stage. Having a portfolio which is distributed across these three different stages, I do believe that you will have an opportunity to get your own golden rectangle and can get sometimes 100 or even in 1,000 times return for your investment. So that's all I had in this video, and I hope to see you in my another video. That's all, my friends. I hope to see you in my next video. If you have enjoyed our content, please like it, share it, and subscribe it. At last, please be good and do good. Thank you.